The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Commodities sliding, small caps slumping, treasury yields near the lowest levels of the year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. A truly ugly day if you're long equities in the market.
Absolutely, and it's intensifying as we get closer to those bells.
Yeah, it's sort of a bad news is bad news situation. The sell-off really picked up steam after the ISM manufacturing data came in. We fell the lowest, or the most, since November of 2022. Here's what we see. The S&P down a full 2 percentage points. Tech getting hit down over 3 percentage points. Where does the money go? The money goes into the bond market, particularly that front end. This is just no better way to tell this story, Romaine. Bad news is bad news. You sell equities, you buy bonds.
Yeah, that chart really does say it all. And you think about where we are right now, 24 hours after the Fed decided and less than 24 hours away from the next U.S. jobs report and benchmark yields continuing that drift downward towards the lowest levels going back to January. The 10-year Treasury posting its first tick below 4% in about 6 months. That's part of an almost 80 basis point slide from year-to-date highs, a drop that Sakchen Sabadra says might be too far, too fast.
To me, it feels like at least the front end of the bond market is overpriced for cuts given the general health of the economy.
But ask yourself, how healthy is that economy really? What, when you have a report today showing U.S. manufacturing activity shrinking the most in 8 months, or another report showing the number of Americans on continuing unemployment benefits hitting the highest since 2021? Or how about those earnings reports from Wendy's, Cheesecake Factory, Starbucks, Hershey's, all noting a retreat in consumer spending as inflation really does take a toll. And of course, that puts even more pressure on big tech to show and prove that their recent run-up in valuation was indeed justified. Earnings after the bell from Apple, Amazon, and Intel. Apple under a lot of pressure to give more information about demand for its next iPhone, while contributions, Alex, from AI is going to be front and center for Amazon.
Yeah, and it's a tough tape. It's going to be a tough tape to report into. So the idea is if you get bad news actually equals bad news, does that wind up meaning that the Fed will cut sooner rather than later, or at this point just cut more? The market, at least the swaps market, is saying they're actually going to be cutting more. So this shows the amount of quarter-point rate cuts by December. And you can see now that number is going up to 3. So it looks like the market's now pricing in 3 cuts for this year. All of that really propelling, Romaine, after we got that very, very weak ISM manufacturing number. We talked to Tim Fiore actually on radio about this, and he's like, demand is non-existent. He said, if you need a reason for the Fed to cut rates, this is the data.
All right, let's kick things off. Ed Al-Hussainy joining us, senior interest rate and currency analyst at Columbia Threadneedle, as we kick you off to the close here on this Thursday afternoon. Ed, you saw the reaction in the Treasury market. Obviously, a lot of that stems from what we learned yesterday out of the FOMC. But of course, getting that manufacturing data this morning, those unemployment claims numbers this morning, certainly not helping the case. And it raises the question, Ed, as what exactly are people pricing in when it comes to this drop in rates? Is it about the Fed or is it about weaker macro conditions?
It's a little bit of both. I think it's a recognition that the Fed is now in a very uncomfortable spot, that the status quo is unlikely to hold into the end of the year, and more questions about whether the Fed will actually have to provide accommodation to the economy and stimulate the economy at some point next year. And that's where the entire rates curve is pricing at the moment. Were you surprised that the Fed wasn't a little bit more dovish in the statement as well as in Jay Powell's press conference yesterday? And would you be surprised if they did not cut rates at their next meeting on September 18th? Yeah, let me put it this way. The Fed's been operating with a fair amount of inertia. They've internalized the fact that data over the course of the past 3 years has been evolving in the right direction, but relatively slowly, with a lot of surprises along the way. So this inertia is built into their strategy. And what we're seeing right now is this inertia starting to come into conflict with the fact that the data appears to be turning. The risks, particularly to the labor market, are increasing pretty rapidly. Would I be surprised if they did not cut in September? Yes, that would be quite dramatic. Obviously, they're aware that market expectations are very elevated, and not cutting into the end of the year would really tighten financial conditions and put them into an even more uncomfortable spot at the beginning of next year.
Hey, Ed, the word in the street is that the systemic funds have more equity positions to sell. They've reduced a bunch, but they still have more to sell. Does that mean equivalently we're going to see more money go into the bond market?
Yeah, money's been coming into the bond market pretty much on a systematic basis since really the second half of 2023, right? We had that big dislocation in 2022, significant drawdowns and outflows, and people have been recovering from that for the better part of the last 12 to 18 months. I think what this really reflects is the fact that the starting level of yields across the fixed income landscape remains very attractive. A lot of those spreads are gone. The wide spreads that we had in the middle of last year have compressed significantly, but the outright level of yields is still very attractive. And so the incentive to rebalance out of risk and into bonds remains, I think, quite compelling.
3.5 on the 10-year by the end of the year. What do you think?
Eminently doable, right? We started the year at 3.8, and that was in an environment where the economy was still very hot. The labor market was in better shape. 3.5% on 10-year yields through the end of this year, absolutely within the realm of possibility.
When you look at the economic picture here, Ed, and I'm just curious as to what's going to be the data point that you, as an investor, from an investment perspective, not as a Fed chief, not as an economist, what's the one that you're going to track the most to give you a sense here of maybe what the directionality of the Fed or really the speed of those rate cuts, how that might shake out?
Now, look, as investors, we're very sensitive to financial conditions and credit spreads. And credit spreads are very tight, reflecting the fact that underlying corporate fundamentals are really good, and to some extent extrapolating the growth and the demand story into next year. If that starts to pull back and we see a more of a disorderly widening in credit spreads, a pickup in rate volatility, that to me would be a really strong signal that the pressure on the Fed to move not just in 25 basis point increments, but potentially faster to get policy into a more neutral stance will definitely rise.
Is your expectation, if we do get that first rate cut, that is the actual start of a cycle, Ed, meaning that they keep going with this? Or do you think this is going to be a cut and then wait and see?
No, I think we're past the possibility that it will be sort of incremental adjustments. It makes sense for this to be a cycle to at least take us to neutral. So think about 3.5% on the Fed funds, and then very quickly pivot to the question of, do we need to provide accommodation to this economy? Have things deteriorated? Have risks elevated to the point that we need to provide assistance to the economy and stimulus to the economy? I think that's business for next year, but getting to that neutral stance will definitely require a sequence over the next 6 months.
All right, Ed, always great to talk to you. Ed Al-Hussainy, senior interest rate and currency analyst at Columbia Threadneedle, kicking us off to the close with the focus on the market as stocks right now hitting session lows. When we come back after the break, we're going to talk about one of the most remarkable turnarounds for a publicly traded company, Carvana. The shares higher today after the used car retailer posted a surprise profit. A conversation with the CEO, Ernie Garcia.
Plus, another take from the C-suite. The CEO of Kontoor Brands, behind the likes of Wrangler and Lee, joins us after a strong earnings print. His view on the durability of the consumer.
And pricing is not the way to drive sales. Those are the comments from the CEO of Shake Shack. That company actually having a pretty good day. The shares moving higher as the burger chain offering up a surprisingly big beat in the most recent quarter and an even more surprise read on its guidance going forward. We'll explain in our Stock of the Hour. All that and more coming up in a second, right here on The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit. Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
All right, we are looking at some retail movers to the downside. It has been a rough go when it comes to retail stocks, right? You got Wayfair, Canada Goose, Etsy, all down quite significantly. The consumer is just really struggling at the end of the day for some of these guys.
I wonder how much of this is linked, how much of it is idiosyncratic, because we get so much of this anecdotal evidence, whether it's out of the retailers, the apparel makers, and we're going to talk a little bit later about some of the restaurant chains here. And they're all kind of saying the same thing, that people are just a lot more cost conscious and, of course, making decisions. Either they're not buying anything at all or they're just buying less.
And also just, not terrible isn't even enough today to support some of these guys.
Yeah.
Like for eBay, for example, when analysts said not sexy but not ugly,
yeah,
then even that stock is still down like 9%.
Yeah, but then it's kind of interesting, too, to see the brands and, more importantly, the companies that really are somehow managing to buck that trend.
Yeah.
And the big question is why? Why are they different?
I'm so happy we have one of them with us right now. Let's stay with retail for a second and go to Kontoor Brands. It is bucking that negative trend. They're the brand behind Lee, Wrangler, and Rock & Republic, reporting earnings that beat expectations and raised its full-year outlook. CEO Scott Baxter joining us there. Let's just pick up on that, Scott. What led to your outperformance? I mean, is it top line? Is it margin expansion? Is it pricing power? What is it?
It's all of the above. It's new products that are really resonating with the consumer. In addition to that, it's real estate gains with our biggest wholesale customers. And the fact that our products are working in the marketplace, obviously, work is really important to our products and people are still working. And we have a really great product line that has a really great value. So people can afford our products and we're seeing them choose us.
So when you say value proposition there, does that mean that you have to compete on price and there's a value war in your area, or you have that pricing power?
No, we have that pricing power with where we sit. Our consumers look at us like they can go ahead and buy a really good brand, the three that you've shown here today, Wrangler, Lee, and Rock & Republic, and they can buy it at a really fair price. And they can also shop for it in the channels that people are shopping in right now because of our wide distribution. So for all those reasons, we're really, really clicking with the consumer right now. In addition to the fact that we've done a really nice job from a marketing standpoint with some of our collaborations that we've done with like Hey Dude this quarter and some of our entertainers. We have Lainey Wilson and Cody Johnson. Cody's new line kicks off next month. Lainey's kicks off in September in the country music arena. So we're making a lot of really good moves right now with the brands.
Talk a little bit more about that marketing. How much of that was kind of the kernel that came out of the company itself, or was some of this opportunistic? Where did it come from?
It's a little bit of both. It was also a really sharp turn relative to how we're marketing now. We're listening to our consumer much more. We've got a much more broad-based consumer. Many more females are into our brands now versus before it was a little bit more male-dominated, especially with Wrangler. But that's really pivoted, and we're really in a good place right now. So I think that and the fact that we're kicking off our first national broadcast media TV commercial. We haven't done one in a few years with Wrangler here in September, which, it's tested extremely well, and we're really looking forward to that coming out in September. It'll be really exciting.
Yeah.
We're really pivoting to a really interesting time in our company right now.
I'm curious. I'm not familiar with the new commercial push here. Where is that going to air? Is that just going to be on normal shows, or are you pivoting this around a specific event, or what?
No, it's going to be on normal shows. It'll be in broadcast TV, normal shows, cable, and then it'll also be with a lot of focus on live sports, too.
Okay.
Going into some of the other areas, though, I want to ask you about Asia. It does seem like you are experiencing some headwinds there. You are definitely not alone. If I've learned anything from conference calls, it's that China is a seriously big problem across all sectors. Can you talk a little bit about demand in China?
We had a little bit of lumpy demand over the last couple of years as their recovery, and we've talked about this a lot, has been uneven. But now we're starting to see that kind of get a little bit even, and the consumer is responding. We've cleaned up our distribution and inventory in the marketplace, which was really critical for us. And we believe we're going to inflect positive for the second half of this year, and talked about that today in our call. So we feel better about Asia than we have in a long time.
What do you feel like is the difference? Do you feel like you just got the inventory out of the way and therefore China feels a little bit more sturdy? Or do you think that the actual consumer is changing its tune?
A little bit of both, but both were really important. And so the fact that they both are now happening at the exact same time is really important.
I am curious about how you sell to folks, Scott. There was a lot of talk coming out of the last earnings about the direct-to-consumer strategy, the growth in that strategy that we've seen. How much of a push are you making deeper into that?
Really big. One of our focuses has been e-commerce. It's been a focus for a few years now. We've got a really good team in place. And now we're pivoting a little bit because we have made really good inroads there with all of our brands. And we're starting to do a little bit more from a physical store standpoint. We have about 600 physical stores in Asia right now. We have about 150 in Europe. And we only have about 40 in the United States. And that's going to change. And we've talked about that going forward. We think there's an opportunity for the consumer because you know what we've found? We've found that the consumer loves to shop from a physical standpoint, touch and feel and be there, and also have the option for e-commerce. So we're going to go down that path.
Just real quickly, with the expansion, particularly here in the U.S. side, with the physical stores here, does that cost work out for you? I mean, there's a reason why we've seen a lot of other of your competitors kind of shy away from having too many retail locations.
Yeah, it really does. You know, for us, you know, we're in outlet malls right now, and it works really, really well for us and our consumer. As long as we get the throughput, which we're getting the throughput in the stores, and we're really thoughtful about how many stores we open, where we open them, and when we open them, and really strong strategic marketplaces for us. So yeah, it works really well for us.
All right, Scott, really appreciate you taking time for us. Scott Baxter there is the CEO over at Kontoor Brands, which of course includes Lee and Wrangler jeans. One of the few bright spots in a day, Alex, where we're basically seeing almost everything down. Some of the worst declines that we've seen all year long for some of the major indices. And Abigail Doolittle just flagged the Philadelphia Semiconductor Index, down more than 8%, the worst day for that index since the onset of the pandemic in 2020.
Yep. Qualcomm, AMD, the like. The NASDAQ now down almost a full 3 percentage points. Also, the Russell down 3.6%. The Russell outperformance picture that we talked about sort of pausing definitely today. It's just sort of selling most of the equity market is how it definitely feels.
And, of course, that big drop in benchmark yields. The VIX elevated on the day, a sell-off in commodities, and, of course, a push ahead to after the bell, where hopefully maybe this market, the equity market, gets some relief from big tech. Amazon among the big companies reporting after the bell, and it's sure to be a critical look at artificial intelligence, cloud computing, and consumer health. A preview when we come back on our top calls. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls. The big movers on the back of analyst recommendations, and we start off today with MGM Resorts. Citi cutting its price target to $59, down from $65. This after the casino operator hinted of softer room bookings around that Formula One race in Las Vegas in November. The analyst now thinks F1 could be an earnings headwind. He's also warning investors that the company's BetMGM service may need more investments. Those shares having a worst day in quite some time, down about 14%. Next up, let's take a look at Datadog. The software company upgraded to buy over at BTIG. 143 is your price target. And this comes after near-term checks on the demand environment with enterprise partners was found by the analysts to be encouraging. The analyst also says Datadog is best positioned to win business from Splunk following its acquisition by Cisco. And finally, let's take a look at Reddit. Raised to buy from hold over at Loop Capital. Analyst Alan Gold expecting the social media company to beat on users, revenue, and adjusted EBITDA when it reports next week. And while Reddit is trading at almost twice its March IPO price, Gould says he's comfortable with that valuation. Reddit shares nevertheless getting caught up in the downdraft today, down about 2%, and those are some of our top calls. We do want to stay in the tech space as we do get Apple and Amazon results after the bell tonight. Investors really are hoping to get promising data out of Amazon to lift the negative sentiment bogging down tech stocks. Joining us right now is Shweta Khajuria, Wolfe Research Managing Director covering the global internet sector. She's got an outperform rating on the shares. All right, this is still a juggernaut, still a cash cow. Give us a sense here, Shweta. I know expectations are high, but give us a sense here as to whether you think that web services side of the business will hold up and whether that will pair well with what we're seeing on the retail side.
Yeah, definitely. First of all, thanks for having me. I've got three things to say. One is that I think that the demand side will likely hold up. Expectations are high, as you said. However, after Microsoft printed, they came in slightly lower just because there's some concern around Azure's cloud revenue growth rate that came in maybe a point or two below, and that caused that ranked some bells of caution. What we are gathering from the checks that we have done on cloud, the demand is holding up really nicely. One data point we could also look at is Google, and Google's cloud business accelerated above 29% because they give the cloud, and then GCP was even faster than that. Mm-hmm. The second is that the industry enterprise customers that we have spoken with continue to say that the demand is doing really nicely. And third is that the company has publicly said, I think it was on Bloomberg, that that the growth is accelerating. Yeah. So we have reason to believe that, the cloud business for them is set up pretty nicely to accelerate.
Well, let's stop there for a second, because they did say that on Bloomberg, and we're basically talking about a business, at least the web services part, something like almost 50% market share, 47, 48% here, 17% growth rate. At least that's the expectation coming out of this quarter. But there's been a lot of discussion now, Shweta, about CapEx spend and the types of investments that Amazon, as well as the other hyperscalers, are having to make when it comes to AI, and not just AI. AI is kind of a weird word to use because it really goes well beyond that. Are you comfortable with that spend?
With Amazon, yes, I am. Partly because the fact that they are actually spending is potentially a mark for the demand that they're anticipating, and that it's a good thing for them in terms of the readiness that they are putting themselves into. The second reason why I think is because they are working really hard, and they've already shown a lot of evidence of it since Andy Jassy came on the helm over the past several quarters, that they're showing operational efficiency gains across their retail business. Their advertising business, which is a higher margin business, is also doing really well. So arguably, Amazon likely will get a bigger pass than perhaps a Meta would, which after yesterday, we saw that their demand is holding up nicely too. But what I'm trying to say is that their margins continue to do really well. They have long runway for growth for their margin expansion. They have strong advertising business. Cloud is on the up and to the right. And so they have some offsets for the DNA that's going to go up because of the CapEx spend. And it's arguably a good sign that they're setting themselves up for demand.
Let's get the really boring stuff, online retail sales and also their physical store presence. I mean, if you combine those two, it's really double what they're bringing in from cloud. What are going to be some of the drivers that will give them even more market share in the e-commerce workplace right now?
Well, the expectation right now is for low double-digit percentage growth rate, at least for the North America business. For them, there are two things that are happening. What we are hearing is that consumer spend is increasingly getting pressured, and there's a mixed shift from discretionary spend to non-discretionary spend. Now, Amazon having more than 40% of the e-commerce market in the United States, they kind of represent the market. But the fact that they also carry non-discretionary items is a plus for them. And it's from our checks, they seem to be consolidating share, arguably gaining share from other more discretionary skewed retailers. That's point one. And the second thing is that they are increasingly developing faster and faster delivery speed. And we have seen from history that when consumers get faster and faster delivery speed, and they're expanding now also into the suburbs of delivering faster, you are more likely to order more frequently, whether it is for groceries or something else, just habituating to the platform. And that should help them.
All right. We really appreciate it. Thank you so much. Really looking forward to it. Amazon stock now down almost 2% as we head into that tape. Shweta Khajuria, thank you very much for joining us, Managing Director over at Wolfe Research. All right, coming on, let's go back to the C-suite. Carvana finding its stride after another profitable quarter. It's our conversation with Ernie Garcia, founder and CEO. That's coming up next. This is The Close on Bloomberg. We are just about half an hour away from the closing bell. It is brutal out there, and it is particularly brutal for one company, Mobileye. That stock down a whopping 23%. Automotive supplier slashing its annual forecast, and a large part of that romaine is due to primarily weakness in China.
Yeah, well, weakness in China, but also specifically weakness in this whole idea of, I don't know, this sort of driverless car revolution that we were supposed to get, or whatever we want to call it, autonomous. And the idea that we've seen the retrenchment here by some of the U.S. automakers, we've seen it over in Europe, and now we're starting to see it in the demand coming out of China as well. So I don't know if this is because of the consumer, or if it's more because of the automakers themselves deciding that they would rather put that investment somewhere else.
Or maybe a combination of the two. They specifically said one of its customers outside of China delayed a launch for a high-volume advanced driver assistant system. So autonomous, but who knows what that actually winds up meaning.
Yeah.
But didn't Fisker go bankrupt in the last quarter too? And they're a customer.
Yeah, well, and a lot of those other companies too. I mean, it's like they never really gained the traction, and Mobileye's kind of been at the center of it because obviously, they make a lot of the key sensor components for this. And I mean, I know they still have Tesla and a few others on the hook here, but when you see a 25% drop in the stock, and that's not good. Worst day, I think, since they went public.
Yeah. All right, and a lot of other car makers also have not reported a great quarter, in part because of China, but also weakness across the board. One company that bucked that trend again is Carvana. This is a used car retailer reporting stronger than expected vehicle sales and revenue in the second quarter. Also had record gross margins. Joining us now for more on this, Ernie Garcia, founder and CEO of Carvana. It's a super basic question. What is driving the growth? What kind of income level? What kind of car?
Sure. Well, I think, since inception, we've sold cars across the credit spectrum, across the income spectrum, across the age spectrum. So we sell cars to American customers buying all the different types of cars that you'd expect them to buy. Our top seller right now is actually a Tesla Model 3, but we're also selling all the kind of small SUVs that you'd expect. So, we sell all the cars that customers want.
We also obviously track what's happening with the consumer in terms of auto loan delinquencies, credit card delinquencies, et cetera. Are you experiencing any impact from auto loan delinquencies? What are you seeing?
Sure. So as part of our business of selling cars to customers, many customers are looking for financing when they buy a car, and we provide that financing for them as well. So that gives us visibility into the health of the consumer on the credit side as well. And I would say, in general, there's nothing too notable to report there. I think there was obviously incredible performance from a credit perspective, post-pandemic in 2020, late 2020 and 2021. I think in 22 and 23, it probably drifted a little bit negative. Most lenders, ourselves included, tightened up credit quite a bit at the end of 23. And I think so far performance there looks pretty good. So nothing too concrete to discuss there.
When it comes to the demand side of this picture, Ernie, and what people want and what they're coming onto those lots to look for here, are you seeing any benefit here from consumer weakness, meaning the idea that people that might have been in the market for a presumably higher priced, newer car are willing to trade down and go for a used car instead?
I think there's probably a ton of macro trends going on. I think affordability definitely drives that kind of behavior. So I think there's no doubt that's true. But I think, most importantly for us, we're trying to give customers the simplest experience we possibly can when they're buying a car. It's a totally new experience. They go to our website, they can click around in a couple minutes, they can find the car they love, choosing from tens of thousands of options. We'll deliver it to their door. They can get financing in seconds. They can sell a trade-in to us in minutes. And so we're offering a really different experience. And I think our focus has been on giving customers the best experience we possibly can, getting more efficient at doing that. And that drove incredible results that we're really proud of, really over the last 2 years. But I think this quarter in particular, where we were both the fastest growing automotive retailer and the most profitable automotive retailer, is, those are two boxes we're very proud to check.
Well, let's talk about fastest growing, because you and the rest of your executives got a lot of criticism over the last few years about the pace of that expansion. And of course, for a certain period of time, it decimated the stock, decimated it. Now, of course, we're looking at what could be probably one of the greatest comeback stories that we've seen for a publicly traded stock in decades. Yet you still got a lot to sort out. You got a lot of locations. Interest expense is still rising here. What's the message to investors here about making sure that this rebound does continue?
Sure. Well, there's a lot in that question. What I would say is I think if you look back at history at any companies that try to build anything that was differentiated, I think it's rarely a perfectly linear path, and it's generally very hard. We've been at this for 11 years. We've spent $10 billion trying to build a completely different supply chain. We've undoubtedly, made some great moves, and we've made some moves that in retrospect weren't perfect. But I think on average, we've always moved forward. And I think that the sum of those moves got us to this spot today, where we're the fastest growing and the most profitable. And not just the most profitable this quarter, but we had, this quarter we had the most profitable quarter of any automotive retailer ever. I think the position we're in now is incredible. I think the team that we have is incredible. I'm forever grateful for them for fighting through the last couple of years the way that they have. And I think from here, the opportunity is really large, right? We're in a huge market. We have a 1% market share, and we've got the team that knows how to go out there and tackle hard problems. So we're going to keep doing that.
If I'm looking at this correctly, your total debt, though, is still $6.2 billion. What are your plans for reducing it?
We'll reduce that over time. I think, this quarter we had $355 million in EBITDA in a single quarter, right? That starts to make that debt look a lot different than it may have looked a year or two ago. And I think if we keep having the gains that we expect to have, we'll keep accumulating cash, and we'll keep looking much better from a leverage perspective as well.
I mean, I hear your pitch, right? The issue is it seems like a lot of the analysts still have holds on the stock. So you clearly have a lot of skeptics out there. How do you assuage them of the fear of too much debt and people are still worried about the fact that will actually make big purchases online?
I think in the real world, if you wait for everyone to cheer you on, you're going to be waiting a long time. So I think our job is to go out there and do the best job that we can. I think, many analysts, I think, are pretty excited right now. Many analysts are completely fairly, standing by and watching and trying to figure out where this is all going to go. Our job is to make as much progress as we possibly can, and so we're going to stay focused on that.
I am curious, though, when it comes to dealing with the debt load, as well as dealing with other obligations that you have here, any plans right now to go back to financial markets, whether it's equity sales or debt sales?
I think, I'll try not to run back the whole answer I gave you before because you called it a pitch, but which was reasonably accurate if we're being honest. But I think the most important thing is just that we keep making progress in the business. The team's done an incredible job. I think we're in a very different spot than we were a couple of years ago. I think that story is still a fair one, but it's a very different story today than it was back then.
All right, Ernie, appreciate you taking time for us. Ernie Garcia, founder
and
CEO of Carvana, on the heels of those earnings last night. Of course, the stock right now up, I think, something like 200% just this year alone. And of course, when you go back to the depths of where they were, a 90+% drop from their all-time highs here, you're talking about one of the biggest turnarounds, at least so far. Question is, does Ernie keep that on pace?
Yeah, and if you take a look at the other car makers, though, it's been really brutal.
Yeah.
Like AutoNation did really well, competitor of Carvana. Hertz also had results out. That didn't go so well for them. But you also have Volkswagen, lower deliveries in China, BMW, warning of China. I mean, the theme continues.
Yeah, and we're already seeing this in the aggregate data here. There are going to be fewer cars sold most likely in 2024 than they were in 2023, if you believe what BI puts out here. The question is, where's that mix? And the question is, what's driving that? Is it about affordability? If you have it to finance in a car right now, you probably don't want to do that. And if you were paying for cash, I guess what? As somebody who was in a dealership, cars are still pretty pricey.
Yeah, but I was curious that when he said that a lot of people are buying Teslas, whereas Hertz has like all the Teslas.
Yeah.
And then they're having a hard time.
They're trying to get rid of some of those Teslas.
That's what I'm saying, but that clearly then there is a demand.
Deals. Just go knock on Tom Brady's door down there at Indian Creek and see if he's got a few extra things there. So.
You were looking for a car? Oh, you got a car.
Yeah, I got a car.
He's done.
Yes,
you're
right.
You can't have two in the city.
At some point, you'll get a ride in the back of my Bentley. But for right now, we're going to move on and talk about some of the other big movers out there. And actually, it's to the upside this time. Shake Shack, an incredible day for the company here, basically saying, look, it's not trying to compete on price, it's trying to compete on service, and it's actually telling folks cash is king, and it's got it. We're going to break it down in our Stock of the Hour. It's up next. This is Bloomberg. Time now for our Stock of the Hour. Shake Shack shares up almost 16% here on the day, best day since February. This after the burger chain said it expects to generate positive free cash flow on an annual basis. That'll be the first time it's done that since 2017. Abigail Doolittle joining us right now for more. And what's kind of lost in all this too, Abigail, is not just that Shake Shack is doing well, but all these other fast food chains seem to be struggling. So why is Shake Shack somehow bucking the trend?
Well, they have this new CEO, Rob Lynch, and apparently on the call, he was super impressive. He's talking about that he knows what the problems are, and here's the solution. So the problem's marketing, which he's really trying to fix. Apparently, they didn't talk too much about it because they want to keep it secret. Operations, and then apparently they have a drive-through problem. So those are the big problems. He's fixing it. So when you put that together, they came up with a 4% comp in the quarter that was encouragingly against this backdrop, because I know we're going to be talking about Wendy's in a moment, but the other day we were talking about Texas Roadhouse. That's another one of these companies that's doing well. But so many of these other fast casual, they're really struggling. It seems as though the consumer that trends toward these sorts of restaurants maybe has a little bit less cash, and so there's less demand. But Shake Shack really pulling in some loyal customers.
What I thought was really interesting too is he really poo-pooed the idea of a value war. Which you talk to any fast food analyst, the first thing they say is we're headed into a value war.
Yeah, he said that that's not the approach that you want to do at all. You want to improve service. You want to make sure that the product is great. The operations and the marketing focus on not competing, not think so much about your competitors, but think about what you can do better. best, and it seems as though it's a good strategy for them. Wendy's, on the other hand, they also have a new CEO, and I guess the call was the exact opposite, that this person did not impress in the way that Rob Lynch did.
Yeah, and I'm curious too, because it's also about differentiation, right? I mean, at the same time, Shake Shack and Wendy's, let's face it, they basically sell the same stuff, more or less. Similar with McDonald's. McDonald's clearly going down the value perspective. I think we were joking right before we came on air that, one of our cameramen got lunch at McDonald's today.
Oh, which
one? Burger, fries, and a drink. How much do you think that was, Abigail? $16. We only have about a minute left. So, sorry, not to cut you off.
Before I
$16, which is
you may
insane
have
to me.
I think that's still.
So I don't know, but it's a long way between the $5 value meal and that. But the question is, where does Shake Shack fit in the middle of that? I guess they've always been more of a premium priced, at least as far as fast food goes.
Yes.
More of a premium priced brand.
I think people really want the actual Shake Shack product.
Careful.
I know, a lot of alliteration there. I've only been there once, but clearly, a higher end burger, the fries, the shake. Right now they have this barbecue burger that apparently is really helping them out. But yes, they're not going down that route in terms of competing on price. And Wendy's, returning to Wendy's, they really cannot. They miss slightly. Their comp not even up 1%. I guess they're apparently still focusing on breakfast, which maybe is taking away firepower that they could put toward their other product. It's interesting. When I was a kid, I haven't been to a Wendy's in probably a few decades, but they had great burgers. Now I'm vegetarian. At the time I wasn't, but they have great burgers.
I
know. I have to. Whenever we
Can
do
I
these
just tell you something
segments,
right now? All this time, I really want a Frosty. You remember Frosty?
That's what I was about to say.
I haven't had a Frosty in years.
That's what I was about to say.
I used to work across from Wendy's, and I think I must have gained like 30 pounds on that job.
That's fair enough.
They're so good.
All right, we gotta leave it there. Abigail, thanks a lot. Really appreciate that. Abigail,
you would never let a
joining
Frosty
us.
cross your lip, would you?
When I was a kid? Absolutely.
Oh, now you're Miss Healthy.
Not a chance. Yeah.
We were trying to ply her with pizza. She's like, no, I got my salad and my greens.
I have my yogurt with nuts and my juice.
Oh, okay. All right. Well,
let's be clear. All right. We're about 15 minutes away from a pretty brutal day in the market as we accelerate to the downside here. We'll break it all down with Nguyen, partner, CIO of Equity Strategies over Research Affiliates.
We see a secular global industrial renaissance going on. And people talk about AI, but it's also in power, it's also in sustainable energy, it's in the auto sector as well. And when you look at the breadth of capital that's needed from these high quality companies, it really reckons back to what happened in the US in the 1920s and 30s in the build out of railroads and industrial America.
The co-president over at Apollo Asset Management, speaking a little bit earlier right here on Bloomberg Television. 10 minutes until we get to the closing bells. Romaine Bostick alongside Alex Steele, keeping our eyes right now very close on a sell-off going on across all of the tapes.
We're off the lows, so if that's any consolation, but it's pretty brutal. The NASDAQ, for example, up by about 2.2%. The Russell, obviously the hardest hit, but now just off by about 3%. Qualcomm doing really poorly. The SOX index, the semi-index, having its heaviest pressure of selling since March of 2020. It's really brutal. Bad news is bad news right now.
Yeah, the Philly Semiconductor Index actually recouping some of those losses, now only down 7% as opposed to the almost 9% that it was down earlier. And it gets to the thing that Jim Zelter was talking about here in this sort of AI renaissance, if you will. How much life is left in that trade? How much confidence is there in that trade? Nguyen joining us right now, partner and CIO of Equity Strategies at Research Affiliates, joining us here in studio too. And let's talk about that trade, because that has basically been the equity market, the public equity market, for really the last year or so now. And I do wonder if that is finally running out of steam, or you think this could maybe just be a bit of a reset, and then at some point soon we'll get back to it.
It's not unusual to have a bit of a reset given how much these stocks have rallied. If you look back to the early days of the internet bubble, or just the internet era, you saw Amazon, growing very rapidly, similar to the NVIDIA story, although from a very much smaller base. And I always take a look at between 1998 and 1999, Amazon had drawdowns of between 25 and 50%, 7 times.
Wow.
And look at Amazon now.
Yeah.
So I think that with these growth themes, with these large, themes that leave much to the imagination, you're going to get a lot of excitement and you're going to get a lot of fear.
Let's stick with Amazon for a second, because they do report after the bell, and particularly on the cost side, because this is kind of what Zelter was getting at. He sees this as a positive. But I'm sure you remember, Amazon got widely criticized back in the 90s for the amount of money that it was spending. It was basically just a money loser. And Bezos kept saying over and over again, there's a long-term strategy here. Wait it out. It'll pay off. Obviously, it paid off. I feel like that's where we are now, except all the companies that are being criticized for this are now the behemoths of the world. They're not small companies with no cash flow, no revenue, no earnings.
Yes, I mean, that's one of the things that we see that it's different, right? I mean, back then you had a lot of the Yahoos, a lot of the web vans. Some of them had capital to survive, some of them didn't. One of the reasons Amazon was able to survive was because they went to the market, raised a lot of capital to back their long-term plan right before the markets closed on the capital raising. But these days, a lot of these companies are self-funding. They're very cash flow positive. They're not going anywhere anytime soon. They may not be the biggest winners over the next 10 to 20 years, but they will be most likely survivors. And so, at Research Affiliates, we're value investors. We've been value investors for the last 20, 25 years, but one of the things we always say is that there still is some intrinsic value in these companies. Don't ignore them. You probably want to own them, but you probably don't want to own them at the weight that they are in the S&P.
Or at the exclusion of anything else, which leads me then to small caps. We're not seeing small caps outperform today. In fact, it's underperformed for small caps. Is that rotation trade done, or are we just pausing out altogether right now?
Anything can happen in the short term, but I do think that small caps are so heavily discounted relative to their large cap brethren. I mean, I think that if you take a look at what their normal relative valuations are and what they are today, small caps are so heavily discounted that if you actually just had a reversion to normal valuation relationships over the next 5 or 6 years, you could see a 7% outperformance annualized during that time. So that just gives you an idea of how cheap they are. These are not companies that are necessarily all terrible. I mean, certainly in small cap, we favor an active approach, something that includes a quality component or even a momentum component to it, I think helps.
Yeah, and some of the earnings, like Sprouts Farmers, for example, have been really solid. To the price action today, is it fundamentally driven? Bad news is bad news and everyone's going for cover? Is it a continuation of the sell-off from last week? Is it just fund flows? What do you attribute it to?
I attribute it to a little overzealousness. I mean, one of the things you're seeing in the bond markets is that bond traders are pricing in 3 rate cuts for the rest of the year. I mean, if you actually had 3 rate cuts, I think that's actually very scary because that would portend a massive economic slowdown. I think 2 rate cuts, you're probably in a sweet spot. Inflation's easing, growth isn't too bad. But 3 rate cuts is a little bit, people are feeling like, there might be some problems out there. I think that's the market's getting ahead of itself. I mean, we certainly are seeing negative surprises on the economic front, more so than we saw earlier this year. But we've seen this before, right? We saw this in 2019, we saw this in 2016. And those are actually pretty good times.
Well, that's what I'm curious. When you see the sell-off here that we've had, not just for today, but really over the last couple of weeks here, and how it's formed here, is this really about the Fed and rates? Is this more about the corporate fundamentals?
I think it's really about expectations. If you look at earnings announcements, you're getting pretty good positive surprises. I think over 3/4 of announcements so far have been positive surprises on earnings. But what you're not necessarily getting is you're not getting the bonus guidance, right? You're not getting guidance above expectations. And so a lot of this is just expectations were inflated, but growth looks like it's actually okay.
Yeah, and so you didn't get too rattled by some of the latest numbers we got this morning on unemployment and manufacturing like that. I mean, you don't really deal with that short-term stuff. I know. I can just tell by the look on your face. You're like, doesn't it know we're long-term investors?
One of the things I always say about U.S. equities is that the biggest mistake anybody ever made was actually just sell it, right? Because once you sell it, at some point you have to get back in. Over the long term, equities perform.
All right, Coy, going to have to leave it there. Always great to see you. Coy Nguyen, partner and CIO of Equity Strategies over at Research Affiliates. Of course, we started the discussion off with Amazon. Amazon scheduled to report after the bell. I think that's the 4th highest weighting in the S&P 500, but we also get the number 1 highest weighting as well, and that's Apple, also down here on the day by about 1.8%.
Yep, the question is, iPhone sales, particularly in China. Is this the time where it's the last leg and the softest quarter, and from here we start to build towards that super cycle? What are those indications? I'm really curious.
We should also point out, this is actually going to be one of the busiest earnings days, at least in the post-market, that we've had this cycle here. Intel
Almost
scheduled to report, MicroStrategy as well as a slew of smaller companies, including U.S. Steel, Block, Booking, Beazer Homes, Twilio, and quite a few others. So we've got a lot to go through. You definitely don't want to go anywhere. And it raises the question here, do those two big cap names, is that going to save the market if they do surprise to the upside?
Yep, and I'm sorry, exactly, but it's already priced in. Like, is actually selling into it not necessarily a bad thing when you come into the tape. We'll see.
Stick with us. Our full market coverage of all of those earnings is imminent, as they say, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, here to help take you through the Closing Bell. It's a global simulcast. It starts now with Scarlet Fu joining us in the television studio, Carol Masser and Tim Stenovic coming into us from the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube.
Yeah.
A major sell-off going on across all of the major equities, including a 7% drop in the stocks.
Yeah, I love that you went there. First of all, we are seeing some buying here at the close, so we're just rounding off our worst levels of the session, but still down across the board. But yeah, kind of blows my mind, right? Romaine, we were up, 7% on the stocks yesterday. Well, they gave it all back today, down 7%, as you just said.
Intel, one of the companies, down 5% in the stocks. That company expected to report results in just a few minutes, along with Amazon and, of course, Apple coming at 4:30. We're going to have those numbers for you as soon as they cross.
What's interesting here is volume. Volume is really elevated compared to the 20-day average. For the S&P 500, about 30% above the 20-day average. For the NASDAQ 100, which includes two big companies reporting, it's 40% above the 20-day average.
And here's also the question, too. I understand, as we're going into earnings, there's a fundamental, like the bad news is bad news. But also in general, there's still a lot of equity longs within the systemic funds, volatility-driven funds, CTAs. And is this just a continuation of that selling that was really triggered over the last couple weeks?
Yeah, and then you're also up against the whole seasonality issues as well here. So that's obviously feeding into the price action as well. A significant drop in Treasury yields today with that 10-year yield looking like it is going to close out the day below 4%. A drop in commodities, elevation in the VIX at 1 point trading above 19. As we get the closing bells here in New York, as we wait some big earnings, let's walk you through the numbers here. Dow Jones Industrial Average looks like it's going to finish the day down by more than 500 points, or about 1.3%. Of course, it takes a few seconds for these numbers to settle, but you get the gist. 76 points lower on the S&P 500, a 1.4% decline. Meanwhile, the NASDAQ Composite down about 2.3% here on the day. NASDAQ 100 down about 2.4%. But let's take a look at the small and mid caps. Dow Transports down 1.7%. Mid caps down 2.1%, and the Russell 2000, Carol, closing out the day with a 3% loss.
All right, back to the big caps we go, though, and most names in the index lower, guys. 330 to the downside, 173 to the upside, Scarlett.
Yeah, but you look at the sector breakdown, and most of the declines, as expected, are in infotech. That group is off by 3 1/3%. And what you want to pay attention to is the bright red slice of that pie. That is semiconductors, and they're off about 7% at the moment. Energy and consumer discretionary each losing more than 2%. The groups that are bucking the decline, utility, REITs, and consumer staples, so a little bit of that defensive buying.
All right, quick check on some of the individual gainers. Meta, guys, finishing the day with a 5% gain. You know this story, rallying big time. One of the top gainers in the NASDAQ 100. Amazon, though, guys. Let's go right to it. It is out.
All right, let's take a look at the EPS, $1.26. The consensus estimate was $1.04. In terms of net sales, that does meet analyst estimates overall, $147.98 billion. Analysts were looking for $148.78 billion. Let's take a look at Amazon Web Services. The net sales there, $26.28 billion, higher than what analysts had anticipated. This is the driving force of Amazon's profits, certainly the cloud business. North American net sales, because the retail business is certainly picking up steam of late as Amazon drives its efficiencies, $90.03 billion. Analysts were looking for $89.98 billion. When it comes to the outlook, Amazon says net sales in the third quarter, this quarter, will be anywhere from $154 to $158.5 billion. Analysts were looking for $158.4 billion. Then third quarter operating income will be $11.5 billion to $15 billion. Big range. Analysts were looking for $15.66 billion.
Okay, I'm looking at Intel right now. The company shares are just cratering in the after hours. Sees third quarter revenue $12.5 billion to $13.5 billion, a huge miss. Estimates were for $14.38 billion. Shares down 9% in the after hours. Intel second quarter adjusted gross margin coming in at 38.7%, also a miss. Estimates were for 43.6%. Sees third quarter adjusted gross margin at 38%. Estimates were for 45.5%. Shares down 10% in the after hours.
Yeah, and the company announcing that $10 billion cost reduction plan to increase efficiency and market competitiveness, implementing a more than 15% headcount reduction, suspending that dividend starting in the fourth quarter of 2024. In 2025, next year, company targeting gross capital expenditures between $20 billion and $23, and net capital spend between $12 and $14 billion.
So that's going to be a little bit whittled away here. I mean, that's what really jumped out at me. You suspend that dividend. You're obviously reducing headcount. This now becomes a cost story. And this was sort of the concern with a lot of these companies about the spend that they were having to do to sort of keep pace with whatever new era we're going into. Some companies will be forgiven for that. But obviously for Intel, at least based on the initial share reaction, not quite so forgiving.
Yeah, let's go back to Amazon, guys, for a second, because that third quarter forecast is what is raising some eyebrows here. Net sales estimates on the high end, about $58.5 billion, and as Scarlett pointed out, is quite a range. That is just in line with what they were expecting before. Operating income, though, to be about $15 billion on the high end. That misses estimates that seems to be very much weighing on shares for the quarter, despite the fact that their physical online stores and AWS growth, et cetera, delivered very much so in the second quarter.
So the big question for Amazon clearly is what they say about how much AI contributes to Amazon Web Services. And each company has kind of done this in their own way. Microsoft talking about the contribution, the points contribution to Azure sales, for instance, but not really itemizing exactly how much it is. So that's going to drive the narrative for Amazon going forward.
Yeah, Andy Jassy flicking at that, Scarlett, in the press release, saying that as companies continue to modernize their infrastructure and move to the cloud, while also leveraging new Gen AI opportunities, AWS continues to be customers' top choice. We have much broader functionality, superior security and operational performance, a larger partner ecosystem, and AI capabilities like SageMaker, Bedrock, Trainium, and more.
But again, some disappointment, no doubt about it. Just to rehash, guys, you've got Amazon down 5% here in the aftermarket. The big headlines, second quarter AWS net sales, that is 26.28. That's a beat, but the outlook, the third quarter operating income, 11.5 to 15 billion, and the street estimate is above that, $15.66 billion.
We got MicroStrategy a little while ago here. Let's get right to it. Of course, the software company that's effectively been operating as a digital hedge fund. Its digital assets in the most recent quarter continued to grow, $5.7 billion right now on the balance sheet. What did that translate into on the top and bottom line? Well, a loss of $5.74 a share, greater than what it was a year ago at $1.52, and revenue also coming a little bit light at $111 million. All
right, just a quick check-in here on DoorDash. Looking at its gross order value for Marketplace, coming in up 20% year on year, coming in at 19.7 billion. That is better than estimated. Revenue also coming in stronger than estimated. Gross margin bang in line with estimates. Orders also increasing, and if you take a look at their third quarter, they're also seeing on the high end about $540 million in adjusted EBITDA. So pretty solid quarter there for DoorDash.
Let's just go back to Intel, because in looking at the different stocks that are moving in after-hours trade, the one that really stands out is Intel because of that drop, a sizable 11% plunge. We knew this company was in turnaround mode, and we knew that the company was going to cut a lot of jobs to reduce costs and everything, but suspending the dividend kind of puts it in a different category, because for a while people were looking at Intel as an income-generating company, an income-generating stock. But this revenue outlook miss really raises a lot of questions about how much progress it's making in improving. It's trying to get back to what it was to its heyday.
On that, it says Intel, of course, taking the added steps of suspending the dividend starting in the fourth quarter, recognizing the importance of prioritizing liquidity to support the investments needed to execute its strategy. The company reiterates long-term commitment to competitive dividend as cash flows improve to sustainably higher levels. I think that's kind of an interesting nuance to what they're doing.
Okay, well, let's not forget, they cut the dividend last year in half, I think. So, and now they're basically suspending it altogether here. I'm not sure what kind of message that sends, particularly for a company this mature.
The actions for this cost reduction plan include structural and operating realignment across the company, headcount reductions, operating expense and CapEx reductions of more than $10 billion in 2025 compared to previous estimates. Intel is looking to achieve a clear line of sight toward a sustainable business model with the ongoing financial resources and liquidity needed to support the company's long-term strategy, reducing OPEX, reducing CapEx, reducing cost of sales, maintaining core investments, and executing strategy.
What does it say about a tech company when they start using words like liquidity and debt balance in their earnings statement?
Exactly. It's
called
all hands on board, right? Rein in all the costs because we've got to kind of preserve whatever cash we have for what we really need to do.
Yeah, for me, the headline that really says it all is they say that second half is now looking weaker and there's an inventory buildup. I mean, this is a straight up, very cyclical business. And as long as the inventory doesn't clear, it's going to be very hard to find that recovery.
All right, guys, we've got Amazon down about 1.6% in the aftermarket, and you've got Intel, really the big decliner here right now in the post-market trade, down more than 11%. All right, that's a wrap on our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We know, Alex, you're heading out. Scarlett and Romain continuing on television. Of course, Tim and I are going to continue on Bloomberg Business Week. Guys, we will see you again, same time, same place tomorrow.
We continue our coverage right here on Bloomberg Television. A slew of earnings out, including the fourth largest company weighted in the S&P, and that is Amazon. Shares down 2% here in after-hours trading, despite 10% growth in net sales. A beat on the bottom line, but still some concerns about cost and the strategy going forward. Poonam Goyal joining us right now over at Bloomberg Intelligence. Poonam, what jumped out at you out of this press release here? Did it give you what you thought we were going to get?
Yeah, it gave us really strong results for the second quarter, but I'd say what surprised me is the operating margin guidance that they've given for 3Q. Came in less than what we'd expect, but I guess the question is why? Because we do still think that AWS margins will hold up at above 30%. So is the issue on the retail side? And that's what we're looking to hear on the call later today.
And of course, this was a quarter that included a Prime Day, so we should have seen big numbers for the net sales part of the retail business. Were expectations higher as a result of that, or has that usually been priced in by this point?
So Prime Day actually falls in the third quarter of Amazon's results. Okay. It's in July, but this quarter did have, these small event sales that they had. Nonetheless, the quarter came in about in line, I would say. At 10%, it was within their guidance for 7 to 11%, and I think that was still respectable.
So talk to us about how they sort of get costs. I don't want to use the word under control, but to at least get their cost structure at a level that investors are going to be comfortable with. And for that matter, analysts like yourself. I mean, this is a company, and we were just talking a little bit earlier with Nguyen over at Research Affiliates, kind of about the parallels of what we saw in the 90s with Amazon, where it was spending a ton of money, not making a ton of money, and somehow investors, to a certain extent, gave them a pass. Now, they're spending a ton of money, but they're still making a ton of money, Poonam. What more do investors want?
I think we just want to see them continue to make more money, right? We're seeing the retail side of the business improve. Yeah. Retail margins now are mid-single digits. I mean, if you asked me 5-10 years ago, I would say not possible, but it's possible thanks to advertising. That business still grew 20+% in the quarter, and we expect those gains to continue. So I think that is where the profitability is going to come from. In addition to the cloud business, which we saw had higher margins in the second quarter, and we do see that cloud business getting to 40% operating profit margins over time.
Poonam, really appreciate your joining us to give us the instant analysis on Amazon. Poonam Goyal of Bloomberg Intelligence.
All right, another earnings crossing the wire. This on Snap. Those shares down 14% here in the after hours trading. A big miss all around here. EPS for the most recent quarter coming in line with estimates, as is revenue. But their guidance they're giving is coming well short. Their third quarter adjusted EBITDA, 70 to 100 million. That's the range they're giving. The street was looking for 110 on average. So even the high end of that estimate coming well below that, Scarlett.
Yeah, no surprise then that Snap shares are dropping 18% right now on that missed view for third quarter adjusted EBITDA. All right, let's take a look at another big decliner in after hours trading, which is Intel, plunging at the moment, double-digit percentages here, 11% lower, as the company makes clear it was a disappointing quarter. Ed Ludlow of Bloomberg Technology, the co-host, joins us now. And Ed, I know you just spoke with the CFO, David Zinsser, but it's notable that even in the press release, the first sentence of the press release is our Q2 financial performance was disappointing.
Yeah, the call with Dave started with the results weren't great, and it was a difficult phone call from there. I think the point or the admission is that they were very slow to adjust their business to the reality of the environment that they're in and their own place in the markets in which they operate. Tim was talking about the long list of what cost reduction actually means. So the headcount reduction confirms the Bloomberg report. You look at the stock down more than 11%. As part of that's relief of confirmation, right? You wonder what might have been, in which direction it goes if it was a surprise. But what Dave said basically is in the markets where they still have some strength, they are not recovering at the pace that they thought. And therefore, you look at the guidance for the bottom line to come, they've had to pull costs out. The biggest admission came on AI, right? Where we've talked all week, the three of us, about where they sit in that market.
They're late to the party.
Yeah, well, what is the admission? That they don't sit anywhere in that market?
They're in the wrong product. So
I thought they were fixing that or trying to address that.
Yeah, I mean, I think that on the call, Dave and Pat Gelsinger are likely to get a lot of questions about that. The quote that he gave me is that we are overexposed in CPU as opposed to versus GPU, and GPU is where all of the investment is happening right now.
Did that sound like a revelation? Because if you had asked me that question, a layman, I could have told you that a year ago.
Yeah, it wasn't a surprise to us. I don't think it's the only thing you and I have been talking about for months.
Yeah, but I was under the impression, and you know this better than us, but I thought this is what Pat was specifically addressing with these build-outs, and I'm curious as to how you grow, how you fill this gap, and at the same time retrenching in terms of headcount and cost.
I think it's an emphasis of strategy thing. In every data center, there are many components. You still need CPUs in all kinds of data centers. But whether you're building a new data center or you're refreshing the technology in an existing one, all of the CapEx we've been talking about so far this week and last with Alphabet is not going to CPU. It's going to the high-performance GPU. Their product Gaudi, the estimate going into this was maybe $500 million of sales in the second half of the year. You note that AMD actually slightly boosted their forecast for their equivalent product. I guess the question, which we won't get to ask, but the street will, the analysts will, is, will you sell anything? Like, you've just given us guidance and a reduced sales outlook. What do you mean you're overexposed in CPU versus GPU? That said, to his credit, Dave did say they still expect growth in those more cyclical areas of the business, PC, other sort of legacy CPU for data center to recover in the period.
But there are big headwinds in that legacy business, right? You've got stiff competition, you've got uneven demand, and you've got the whims of what's the broader environment overall. We know Intel has been seen by traders as kind of a U.S. pure play chip maker. It's gotten money from the government under the CHIPS Act. So like that's kind of a feather in its cap, I suppose. I mean, what are they doing with the money that they're getting from the government? Where are they deploying it?
In the time that I've known Pat Gelsinger, he talks about something called smart capital, that you accept that all the money you need to build the industry back in America, you can't do it on your own. So it's a combination of your balance sheet, strategic investor, and we've done stories about Intel with some sort of specialist financing from Wall Street, and then there's the government component. What was really interesting is that they mentioned both OPEX and CAPEX as needing to be cut back significantly. That's really hard to understand. But then you note they reallocate it to that growth of the foundry business. That's what Dave was talking about. Still, I find this really hard to explain. Just one really quick thing. They launched their new AI PC product, but they did it from a fab in Ireland. You mentioned US, but they actually did it from a fab in Ireland. Their original plan was not to do that at all. And he was talking about how that was a really big impact on margin erosion, having to make that strategic decision. It's kind of a management story, guys. And I'm sorry to say that, but I've never seen this happen.
And that raises a lot of questions. I mean, we're 3.5 years into Gelsinger's tenure right now. He's been on the hot seat from day one, and a lot of questions from investors as to when he's going to actually, I guess, satisfy them. I also just want to point out, and our thanks there to Ed Ludlow, a co-host of Bloomberg Technology there. And just before we move on, Scott, I just want to point out, because I was just taking a look to see how much a suspension of the dividend gives them. As of last year, they had paid out about $3 billion of dividends. So presumably, if they suspend this for a full year, in theory, that's $3 billion in their pocket.
Again, I go back to that idea that in the press release, the CFO talks about meaningfully improve liquidity, reduce our debt balance. This is supposed to be a growth company. When you have words like that pretty high up in your press release, that signals something to investors.
I came in today looking at all the earnings we got, and I thought, I really want to hear what Tim Cook has to say. I really want to hear what Andy Jassy has to say. I think the conference call of this earnings season is going to be with Pat Gelsinger and Intel.
A painful one if the conversation Ed had was any indication.
Yeah, one of the biggest decliners in after-hours trading. A few other stocks moving too, Scarlett.
Yeah, let's take a look at Coinbase, right? That company will be reporting soon, but let's start first with Block because I see that pulled up on my screen. Let me just pull that up.
Let me just hit Coinbase right now here. Revenue in the most recent quarter did beat $1.5 billion roughly. The street was looking for $1.4 billion. As far as transaction revenue, that also came in as a beat at roughly about $781 million. We should point out here that EPS, I'm not seeing a comparison here, but they did post EPS of about 14 cents. And the guidance going forward, the company says its 3Q subscription and services revenue should be in the range of $530 to $600 million. And that says its new product for retail users is gaining traction. The share is only up about 1%, but we have a conversation just shortly ahead with the CFO of Coinbase.
Okay, I've got Block up now. I typed in BLK, which of course is BlackRock, because Block's ticker is SQ. The company formerly known as Square is down in the after hours. Oh, actually, it's turned around. It's now up 1.3%. And let's give you the outlook here for the third quarter. See, third quarter gross profit of $2.22 billion. Bang in line with analyst estimates. Full year adjusted operating income is now $1.44 billion. Previously, it had seen $1.3 billion, so that is an upgrade in terms of its outlook for the full year. We'll have more details as we get them. This is Bloomberg. All right, we are all over earnings right now, and DraftKings is lower in after-hours trading after it came out with a forecast that goes in a lot of different directions. Full-year revenue, it says, it will now be anywhere from $5.05 billion to $5.25 billion, which is an upgrade from what it had previously anticipated. But when you look at full-year adjusted EBITDA, that is now going to be $340 million to $420 million, when previously it had seen at least $460 million. So the stock bouncing around right now, but still off by 5% in the after-hours trade.
All right. Of course, that's one of the big movers to the downside. Let's take a look at a mover to the upside. That is Coinbase. The share is up about 2% here in after-hours trading. Its earnings just crossing the wire. $1.5 billion in revenue in the quarter, slightly above consensus estimates on the street here. And the guidance going forward also seems to be a tick or two above what the street had modeled. Joining us right now is the Chief Financial Officer over at Coinbase, Alesia Haas. Joining us for this conversation as well as our very own Shonali Basak. And Shonali, I'll turn it over to you.
Thanks, Romaine. Alicia, thanks for joining us. You know, you look at these numbers, you beat on revenue, you beat on transaction revenue, you beat on subscription services, and subscription services coming in at almost $600 million brings it at more than 42% of that total revenue number. Is there a point in time that you can see in the near future that that subscription services revenue is going to actually surpass that transaction revenue? And how fast can that happen?
Well, first, thanks for having me today. We're really pleased with the growth of subscription and services this quarter, as you note. We grew in every category of subscription and services and reached $599 million, a new all-time high for us. One of our goals has been revenue diversification, and we're pleased to see that mix play out over time. We don't look at when it will cross, Shonali. We look at growth of each of our revenues, diversification of all of our revenue streams. And when I look at our transaction revenue, it does ebb and flow with volatility for spot trading. But what we're pleased to see is continued growth of that other transaction revenue. Base has become one of the biggest contributors to other transaction revenue, and the building blocks are just getting started for lower cost payments. USDC on Base now is free. We're seeing $20 billion of transaction volume of USDC on Base over the last 2 weeks. And so as we think these building blocks come together, we could see diversification of transaction revenue as well. But really pleased with our subscription and services performance this quarter, as you noted.
Please double down on that. Base is a relatively new product here for Coinbase. How is that going to start contributing to a greater scale at the bottom line? What exactly are people using on Base that is creating more of a cash flow stream for you?
So just to remind everybody what Base is a layer 2 solution, which means that it sits on top of Ethereum and it's enabling faster, cheaper transactions. And so that has been our goal, driving faster and cheaper transactions to a mission that we have of 1 second and 1 cent. As I said, over the last 90 days, we saw it come down under a cent for each transaction. And what that led to is 300% transaction growth quarter over quarter. This is enabling developers to build new applications on top of Base that can benefit from embedded payments within that application. And we're seeing all sorts of creativity emerge in this space. We're seeing people build new social networks. We're seeing new types of games. Just creativity is blooming on the Base network. And that's what our focus is right now. Driving that developer activity. Developers will then bring users. Those users will drive transactions, and those transactions will turn into sequencer fees that will bring revenue to our P&L.
How long does it take for that to play out? What are you modeling right now, Alesia?
Well, it's early days. And so what we're pleased to see is that we become the #1 layer 2 in terms of contracts posted. So that focus on developer activity is where our energy is right now.
I have to ask you a little bit away from the earnings in the here and now and more about kind of the future, the regulatory future, if you will. We spent the last couple of years really sort of wringing our hands about what Washington might bring on the crypto industry. Obviously, that didn't come to fruition. But of course, this has now become a campaign issue here in the United States, at least. And I am curious as to whether you are still sort of anticipating that you could see additional regulatory oversight come down the pike for crypto.
This has been a quarter of momentum. So we had so much movement for our goal of regulatory clarity this quarter. We are very grateful to Senator Stabenow, to Representative McHenry for their efforts to bring forth bipartisan legislation in the House and the Senate. We saw overwhelming support of FIT 21 in the House as it passed with bipartisan support, and we are really optimistic that we might see continued momentum into the fall on the Senate side. So our energy is there. It would unlock massive potential for crypto as well as Coinbase if we could bring clarity to the United States.
At the end of the day, one thing that's still in the air, Alesia, is this idea of staking. And staking revenue was a meaningful contributor in the recent quarter and prior quarters, to that matter, for subscription revenue. How uncertain is that revenue line based on the current regulatory environment?
Well, as you know, whether or not staking is a security is a matter of our lawsuit with the SEC. Staking is not a security. We offer a technical service to enable our users to stake with our services on our platform. What we're pleased to see is, despite the headwinds of the regulatory uncertainty, we've been able to grow our blockchain revenue over the last few quarters. We believe this is an area that, with regulatory clarity, it would unlock capital and investment across the board. One thing that we note is that 90% of institutional investors believe that regulatory clarity would unlock capital and their engagement in the crypto space. And so this is another reason why we continue to drive forward this clarity through legislation, through our lawsuit, and through our advocacy work.
Alesia, now it's been a little more time as well with the ETF launches, the spot Bitcoin ETF launches and the spot ETF launches as well. When you look at the read through for what it means for Coinbase, remember initially a lot of people were worried that it would start to really impact Coinbase's business model negatively, but then you've served as a custodian for a lot of these launches. What has been the ultimate impact?
This has just brought a flywheel of engagement on our institutional platform. So what the ETFs unlock for us is we've been named custodian on 8 of the 9 Ethereum ETFs. We were 8 of the 11 original Bitcoin ETFs. And what we see then is we offer custody services. We see incremental trading from our institutional clients. We've seen growth in our financing business. But what we've also seen, if you look at our Q2 results, is we've seen a higher percentage of our trading volume now come from Bitcoin and Ethereum on our platform in the last 2 quarters. So we have not seen cannibalization. We've just seen this to be the tide that lifts all boats and broader engagement in the crypto space.
I am curious, Alesia, I mean, it's going to sound like a dumb question, so just forgive me, but have you guys talked or had any serious discussions about, I guess, expanding this business, meaning expanding its reach and its breadth beyond just crypto?
What I think is really important is there is so much to do in crypto, and that is where our focus is. That is where our skills lay. And so we are going to be building blockchain native, crypto-friendly solutions. Where there may be overlap with, we can leverage licenses, we can leverage technology that we've already built, we may explore going into adjacent markets, but our heart is in crypto, and that's where our focus will remain.
And Alesia, when you think about the future as well, if you think about the ability for Coinbase to grow through this, is Base going to be the biggest driver in the future, or is there another place investors should be looking at?
We believe that we're going to see growth across our product suite, and that is what our focus is, diversifying our revenues to build into the future of utility. I think Base can be a big part of that. I think USDC can be a big part of that. I think our smart wallets will be a big part of that. But the key here is that we are building the building blocks and Lego pieces to drive forward a future of utility in crypto, and believe that with that goal, we will drive user adoption across the portfolio of products that we have.
Alicia, great to have you. Alesia Haas there, the CFO of Coinbase, right on the heels of their earnings. And, of course, our thanks to Shonali Bassick as well. Scarlett, let's get back to it. A lot of other earnings crossing the wire, including some of the big ones that we were just talking about.
Yeah, I want to go back to Intel because it really is pretty remarkable. You had a second quarter miss on all the big metrics, EPS, sales, margin, and a big miss on the third quarter revenue as well. So the turnaround effort is simply not delivering. The legacy business is fairly sluggish. That's a 14% drop right there. Amazon down by 5%. Profit outlook misses. AI spending is still a theme, as with all the other hyperscalers. Snap losing 18% right now on a jump in paying subscribers, but its revenue was definitely a big miss. So you can see that down about 18%. DoorDash is kind of the bright spot here for me, Romain, up 13% at the moment as adjusted EBITDA forecast for this quarter beats analyst estimates.
All right, some other earnings that we didn't quite get to. Roku shares higher here, a big beat here all around, particularly on the revenue side, and the company providing a gross profit forecast in line with estimates and adjusted EBITDA higher than what the street was looking for. Atlassian, though, moving to the downside here, and this gets back to the software question. When you talk about Microsoft, you have to talk about those second-tier companies, and when you look at the softness on the revenue side in the most recent quarter, as well as softness in operating margins, some concerns here about what could happen. Apple earnings crossing the wire right now. Let's get right to it here. The company's fiscal third quarter numbers, and well, they're looking a little good. $85.78 billion in the most recent quarter. Kind of hard to say that. $86 billion in revenue generated in the most recent quarter. The street was looking for $84.5 billion. iPhone revenue, 39.3 of that. That's also a beat. It's Greater China revenue, a miss at $14.73 billion. The street was looking for 15.26. Let's go to the bottom line. Scarlett, $1.40 in EPS in the most recent quarter. The street was looking for $1.35.
So I'm definitely paying attention to that iPhone revenue number because that makes up two-thirds of its product's revenue, and overall product revenue is seen as staying flat for the quarter. $61.5 billion, slightly higher than what was anticipated, but we're not looking at a lot of growth here on the product side. Service revenue, $24.2 billion. Analysts were looking for $23.96 billion. This is the high margin business for Apple, but it's the secondary business of Apple, at least at the moment. Let's bring in Emily Chang right now. She is host of The Circuit, and she has just gotten off the phone with the Apple CFO, Luca Maestri. Emily, what did Luca have to say?
Hey there, Scarlett. Look, Luca said this is a good quarter for us, a really, really good quarter, and a better quarter than even we expected. Their install base hit record highs in every geographic location. It was a beat across all product areas. But as you say, definitely some points of weakness, the main one being China, where we saw a bigger decline, a $1 billion decline in revenue in Greater China, which is even bigger than we expected. So I zeroed in there, just why is this happening? Is it due to the popularity of local brands? And he pointed out that this is actually better than their performance in China than they did in the first half of the year. So they're happy with that. He also said that more than half of the decline is due to currency issues. That's the reality of a strong U.S. dollar. The underlying demand of the products, again, in China is better than it was before. So he just wanted to point out the relative situation of what's going on with the broader Chinese economy. They do realize it's a competitive smartphone market, but they feel that they're doing quite well in the broader context.
Did you get a chance to ask him about that wearable segment? We did see revenue down 2.3% year over year. And let's just be honest, Emily, nobody's really talking about the Vision Pro, at least not the way that maybe they had anticipated. We should have been talking about it. What did he have to say?
Obviously, the Vision Pro had a huge splash, but, he said we're rolling it out to more and more countries. We're really excited about international demand, but you're right to point out that the wearables category is one where we're still seeing those signs of weakness. He said there's a lot more to do there. Specifically, they're bringing new immersive content. They're happy to bring, more and more features. And they're also happy with the engagement that they're seeing in the enterprise world. So he's hoping that that will be a potentially new and very big unlock.
Okay, Emily, the big question that everyone's asking Tim Cook is, what about the AI integrations into the iPhone? This was not a story for the quarter that just ended, but it's going to be a story for this quarter and the year ahead.
Absolutely. And Apple has already released the upcoming version of iOS to developers, so they are tweaking that now. It's not going to come out to the public, to all of us, until later this year. I did ask Luca Maestri, are we going to see a super cycle? Are we going to see, all of these iPhone customers super excited to upgrade to a new quote unquote AI phone? And he wouldn't make any forward-looking statements or try to predict the future, but he did play up these new Apple Intelligence features where they're, focusing on the privacy-first approach. He said they're really excited about the features. They're personal. They're relevant. He thinks people will really enjoy them, and that Apple Intelligence will be another reason to upgrade. He also highlighted the ChatGPT integration that, again, is coming later this year.
Emily Chang, host of The Circuit. You can catch that every Wednesday at 6 p.m. right here on our Bloomberg properties. As we continue a closer look at Apple, the shares continuing to move higher in after-hours trading. A beat in the most recent quarter. We should point out a record quarter in terms of both revenue and profitability for the company. A surprise jump in iPad revenue, up about 24%. A not-so-surprising drop in iPhone revenue, down about 1%. Wearables down 2.3%. Gil Luria joining us right now, senior software analyst at D.A. Davidson. And Gil, I do want to start off with two of the weak spots here, wearables and iPhones. And clearly that drop in revenue we saw is partly a symptom of just kind of the cycle, right? I mean, we're kind of in the middle of this sort of Apple iPhone upgrade cycle. We're going to have to wait maybe, I guess, in the next couple months to learn when that next iPhone comes out here. But did that drop in revenue give you any type of concern in those two units?
Not at all. Until we get the AI features integrated into the iPhone, the upgrade cycle won't even start. That's going to happen towards the end of the fourth quarter, but it's really about next year. Once folks start using those AI features, they're going to get excited. They're going to upgrade their phones. It'll become contagious, especially during the holiday season and into next year, which will drive a big iPhone upgrade cycle. We expect iPhone sales to grow 10% next year, bringing the whole sales for the company up to the high single digits. And one of the reasons that's going to happen is that it's going to pull the other segments. It'll pull wearables. It'll pull services with it. That's why Apple is always the best investment ahead of an upgrade cycle, and that's what we're coming up on.
Let's stick with that upgrade cycle for a second, Gil. When we talk about these new products, assuming that we do get them in the next few months here, is this a sense here that it's just going to be existing Apple users, meaning people already in the ecosystem, upgrading, or do you think this will pull in new customers, people maybe trading over from Android or whatever other device they were on?
It will mostly get current iPhone users to upgrade. If somebody is a hardcore Android user, they actually have some of these AI features starting to come in as well. Apple isn't first to that race, but there's a lot of folks with iPhone 12s and iPhone 13s that haven't upgraded in a while. And when they see their friends and family members that have an iPhone 15 Pro or an iPhone 16 starting to do these cool generative AI features using those on their phones, it will compel them to upgrade. Yeah. That's what's going to really drive this. It's folks have not upgraded in 3-4+ years. Yeah. There's a big upgrade cycle coming for those folks, and that's what this represents.
Scarlett, I'm walking around with the iPhone 12. I just
the iPhone 12.
I don't even pull it out in the subway. I'm just too embarrassed.
It's too embarrassing. Yeah. Well, sales of the iPhone overall did come down slightly from a year earlier. It topped analyst estimates, but it was down versus a year ago. And a big reason why, perhaps, is weakness in China. That continues to be a weak spot for the company. Gil, is the weakness in China, and we see the iPhone dropping from the top 5 in that country, is that a cyclical problem for Apple or a structural problem?
Well, China is very tricky, but before that, I'll say, Romain, you shouldn't be ashamed to pull out the iPhone 12 because it looks exactly like the iPhone 15. Nobody can tell the difference. That's the point. That's why they need an upgrade cycle. In terms of China, the cross currents there are very, very tricky. You have a challenged consumer in China. You have a government that's trying to retaliate against our chip measures by limiting iPhone sales. And so we're going to have volatility in the Chinese market for the foreseeable future. That doesn't mean Apple doesn't have to be there. They have to be in China. It's too big of a market. They have too many customers there. They need to serve the market, but it will be the main driver of volatility because it's not just about the growth and the features and the upgrade cycle. It is about those things that have nothing to do with technology and phones.
So it's completely out of Apple's hands when it comes to those geopolitical headwinds. We know that Apple is offering deep discounts in China. I wonder, when analysts talk about how they want to see continued stability out of a market like China, and you mentioned that it'll be a source of volatility, what ideally would continued stability out of China look like?
So Apple does have a little bit of control over this. Tim Cook is important enough that he gets the best meetings when he goes to Beijing. And so he can try to guide the Chinese government to not use Apple as a tool in its war with the U.S. on the trade front. That is something they control, and they have subtle diplomatic moves they can take on their own side. So that they do control. They can also make the feature functionality better. This will matter. The fact that AI functionalities will matter in China, just like it'll matter everywhere else. The high end of the consumer there is going to want the best functionality. They always do. And that will drive iPhone sales. So China will be part of the global market. It's just that the volatility comes from things that they have little control over, but they do have some control.
All right, Gil Luria, really appreciate your joining us with the instant analysis. Gil Luria is senior software analyst at D.A. Davidson. And we know the iPhone is geared up for big things. It's just not here yet.
It's not here yet, too. And it makes a point. He was kind of being joking a little bit about how all the iPhones, the most recent ones, look the same, so it shouldn't be embarrassing.
The guts inside are different.
But it gets to the idea, because remember that's been the criticism, that a lot of the upgrades we've seen on these iPhones have been very incremental, right? Like a few extra pixels, a couple of features, not enough to really entice a lot of people to upgrade, particularly when a phone, most of these phones are going to cost you about $1,000 or so. So maybe these AI features, certainly not for me, but for other people, that might be enough to kind of drag people up to upgrade.
Yes, but we know the new phone comes out in September. We know the new iOS comes out in September, but they'll have to incorporate the AI stuff a bit later, I believe in October. So it'll take another update to the software before you, if you buy the iPhone 16, can really enjoy those features.
And it's important you point out how it's going to take a while, because they made that clear that this isn't all going to come at once. And then, of course, we've now learned that it's not even going to come in every country. So maybe if you're in the U.S., you get lucky, but if you're in Europe, forget it. And who knows what's going on over there in China. But it raises the question, too, that when they do introduce it here, like, what's the marketing pitch? Because I know there's a lot of substance in AI, but we know there's a lot of hype as well. So I do wonder what the marketing pitch ends up being.
Yeah, if you've watched the Olympics, you know that the commercials touting Google Gemini, it leaves you kind of scratching your head, wondering, like, do I really need this in my life?
Yeah, absolutely. Well, Apple holding on to its gains here in after-hours trading. A few other big movers we're keeping an eye on. Roku shares actually posting pretty decent gains here in after-hours trading, to beat on the top and bottom line. Cloudflare, I was keeping an eye on that, particularly in the wake of the big cybersecurity issues with CrowdStrike recently here. Cloudflare getting a nice bump here in after-hours trading. But Atlassian, I really want to talk about this team. We don't talk about this company, application software here. And this was not an awful quarter, but this gets back to the question of high expectations and the idea that people really wanted to see these hyperscalers, these software companies really sort of benefit from all this spend. And at least for Atlassian in this particular quarter, not seeing it. And you see the shares there, Scarlett, down 12%.
I love you bringing up these companies that don't get as much love or attention as they should, simply because the oxygen is taken by all the Mag 7 names. Here's what used to be a big tech name, but has become a lot smaller. Intel off by 17%, deepening its losses here. Really big question marks over what is happening over there.
I am completely flummoxed by this. And just Pat Gelsinger, he's got a lot of explaining to do. I mean, he's on the call now, but he's got a lot of explaining to do about the strategy going forward. He's been selling us on a long-term vision for 3.5 years now, and this is where we're at: a cut in dividend, a suspension of the dividend, and a 15% headcount reduction.
They've been in turnaround mode, and it hasn't turned around at all. So we'll continue to keep an eye on that. All of them down. DoorDash, surprising to the upside, up 13%.
Hey, I ordered something today.
That's why. Has emerged as somewhat of a dark horse for its strategy to incorporate AI into its devices and services, making a pact with OpenAI that kind of came as a surprise. Bloomberg Opinion's Dave Lee says moves like these should show investors that Tim Cook is, quote, the AI kingmaker, saying Apple's deal with OpenAI, yes, acknowledges the company is behind on AI, but make no mistake, it's temporary outsourcing. So here with more on this is our very own Dave Lee. But we're not going to hear that this quarter or next quarter, are we?
No.
It's a slow ramp up.
It is a slow ramp up. I mean, investors are hoping they'll get some kind of indicator from Tim Cook when they have the earnings call in, 10 minutes or so, just sort of giving a sense of what Apple's expectations are for when they do add these AI features to the iPhone, how that's going to affect sales. The iPhone has been in a fairly prolonged slump. Investors and analysts, they're saying, this could be the start of a super cycle once AI is added to the iPhone. And, the reason why I describe Tim Cook as the kind of AI kingmaker is that you've got all these other companies, OpenAI, Anthropic, whoever, trying to find ways to make users use their AI. Apple can just go, here it is, it's on the iPhone, and already that's billions of devices. And so the decisions he makes, and it was notable they partnered with OpenAI before the other companies, the decision Tim Cook makes does determine which AI tools might suddenly become the most used in the world. But the question is, will that make people want to buy a new iPhone, or are they just going to be happy with the one they've got?
Okay, well, that does sound like kingmaker thing, so maybe that was a great choice of words by whoever used that. I am curious, though, Dave, but you talk about that, and I understand that they have this broad ecosystem, and that's kind of the power that makes them king. But I think about the Vision Pro when that came out, and the idea that it was kind of like, if you build it, they will come. And the developers didn't really come. They were kind of like, we don't really see the use case. And I know the iPhone's kind of a different animal because it's an existing product that's sort of proven itself. But do you think he's going to run into any of those issues with AI development on the iPhone where some of the developers just don't see the value proposition?
Well, we certainly have this issue of what exactly are people going to use AI for? And is it worth all this effort? And, companies all this week have been talking about increased CapEx to make sure that AI is developed and supported. I do think it's a slightly different proposition to the Vision Pro, and it's interesting. On the Bloomberg Live blog, Mark Gurman, my colleague on Bloomberg News, mentioned the Vision Pro wasn't mentioned at all in the earnings release today, which is quite remarkable. Right? I mean, this is
the other bets.
It is the other bets from Google. It's kind of buried in there, and given that was their sort of innovative thing this year, it's quite interesting that hasn't sort of played out. And so, AI, can it be like the Vision Pro? Possibly. I think it's going to be more of a sort of profound step than AR at this point.
Do you have one of those things?
No, I don't.
It's $3,000. So here's my question. The AI, once it's enabled in the iPhone, do you opt in or do you opt out? Are they going to make that the default?
There's going to be options to add certain enhancements. So, for example, the OpenAI aspect of this. This is when the device can't answer the question itself using Apple intelligence, which is their calling for AI, but will sort of go off device and find out more information. That will be up to the user, and it'll be interesting to see just how many people actually feel the need to go off device to help them on their phone.
All right, Dave, got to leave it there. Dave Lee, Bloomberg opinion columnist. We are all over Apple right now. Those shares actually now oscillating between gains and losses in the aftermarket. We're going to continue the discussion in just a second. Stick with us. This is The Close on Bloomberg. All right, after slumping sales in 5 of the past 6 quarters, Apple actually returns to revenue growth. Now, a lot of questions here about its flagship product, the iPhone. $39 billion in revenue in the most recent quarter, exceeding what analysts had estimated and setting up for what could be even greater revenue as it's set to release a new version, iPhone 16. Later this year. At least 90 million devices said to be shipped, apparently, at least according to Bloomberg reporting. Mark Gurman joining us right now to talk a little bit more about a new super cycle. All right, let's just start with it here. All right, if we get this iPhone in September or sometime over the next couple of months, it has the new AI features. 90 million shipped. That's not a whole lot more than what they shipped for the iPhone 15 out of the gate, is it?
I'm not anticipating a super cycle personally. I think those days are long gone. We haven't seen a true super cycle for the iPhone in probably half a decade at this point. In terms of Apple Intelligence, I personally, in terms of driving sales of Apple products, I see that more as a second half of 2025 thing, even into 2026. We are a long way away from the ultimate vision that Apple showed in June of Apple Intelligence, of Siri being able to do things on your behalf. Right now, Apple Intelligence, I've been testing the first beta version. It is quite limited. You're talking about email summaries. You're talking about summarizing text message notifications. You're talking about the ability to summarize phone calls you just had. Nothing particularly game-changing, nothing that people are going to buy a new phone for. And so I think consumers have to understand the delineation between what's coming this year and what's coming in the future. And I think next year is really when sales are going to be impacted in a positive way by AI. I wouldn't expect that to happen this year. And I think Apple's forecast for not really showing much growth in iPhone hardware unit sales through the rest of the year indicates that they probably feel the same way.
You've been reporting on some foldable iPhone that Romain is really intrigued by because he's in the market for a new iPhone. Is that something that's tied in any way to Apple Intelligence, or is that just, a new flashy phone that will look substantially different from what we've been seeing?
Apple has been exploring foldable devices since around the time that Samsung launched its first foldable around 2018, 2019. They've looked at a foldable iPhone, they looked at foldable iPads, they even looked at touchscreen Macs that you could consider a foldable. I don't anticipate any foldable Apple product to be released within the next 2 years. I think that's more of a very late 26 or sometime in 2027 or 2028 thing. So I think we're a ways away from that. That is separate from Apple Intelligence. Certainly any new Apple device that goes on sale in the next few years will run Apple Intelligence, but that's really the only connection between the two that I see.
So it gets to, and it's interesting, the foldable stuff, but it gets to this idea too. We were talking with Gil Luria, who kind of analyst, who kind of talked about this idea how, there really hadn't been major product differences in some of these upgrade cycles that we've had recently, and maybe that's been part of the reason why you haven't seen greater adoption. But basically, the things they've been adding to the iPhone and the iPad have been somewhat incremental, and the idea that investors maybe want to see a much bigger leap. When do we get that leap, Mark?
There's going to be a lot of people that disagree with this, particularly at Apple. But I would say the pace of innovation, particularly around the iPhone, in terms of major changes, major overhauls, major new features, it has slowed down dramatically compared to what you saw many years ago. Certainly you are getting new features. There was titanium last year. There was the dynamic island a couple years ago. You're going to get a new button on the top of the iPhone, on the side of the iPhone.
Wow.
That's, when you use a DSLR camera, you can touch it lightly to do autofocus, and you press it. It's basically turning your iPhone into a DSLR camera, giving it that that physical button. So that's kind of cool. Are people going to buy new phones because of that? Yes, I will. Maybe you will. Maybe a ton of Apple fans and tech consumers will.
But you're not normal, Mark. I mean, you're a tech guy. I mean, you understand. I mean, most of their customers are just regular people who just basically use like 2 apps on their phone.
And I would argue you'd get confused if they're going to add a button because they had a button, a home button, they took it away, and now they're going to add another button in order to take pictures. So we're kind of going back to the future here.
All right, Mark, we got to leave it there. I wish we had more time. We could talk about this all day, and we didn't even get to my real question for you, Mark, which is, when am I finally going to get that Apple car? Mark Gurman, who covers all things Apple for us out there in LA. Let's set you up for some of the big market-moving events here over the next 24 hours, Scarlett. And we have earnings coming out in the morning from some of the big oil and gas producers.
Big oil. Chevron and Exxon will both be reporting. We'll also be speaking with the Chevron CEO tomorrow, so look for that.
Yeah, big interview there. Mike Wirth going to be joining Alex Steele. And of course, we'll have a full play out of that throughout the day right here on Bloomberg. But you can see it first at 10:15 a.m. on Bloomberg Open Interest. 8:30 a.m. before that comes something even bigger, and that's got to be the U.S. jobs report.
The non-farm payrolls report right now, the consensus is for 175,000 jobs added in July after 206,000 were added in the month of June. We're looking for the unemployment rate to stay the same at 4.1%.
And it takes on even more importance on the heels of that Fed meeting, even more importance on the heels of that ISM manufacturing report we got this morning. Durable goods and factory orders from the government coming out tomorrow at 10 a.m. Thanks for joining us here on Bloomberg The Close. We'll be back tomorrow. Balance of Power is up next.